It is January 2nd, 2026. What I'm breaking down isn't speculation, a forecast, or some theory on what could occur. It is unfolding now. The switch was flipped. At midnight Beijing time, January 1st, the Chinese silver export bans went live. In 48 hours, the global market started fracturing in real time. If you saw my prior analysis, you knew this was inevitable, yet the sheer velocity and ferocity of the fallout have stunned almost every single player involved. This was not a smooth transition phase, it was pure chaos. Industrial buyers panicked hard, retail stackers scrambled for exposure. Behind the curtain, procurement squads, refiners, and the big institutions all hit the same realization instantly: the silver market they knew is gone. Today is the day one aftermath report. No opinions, no hype. Just the raw facts of what went down when China dropped the ban, how markets jerked, how price reacted, and why the next phase could be way more dangerous than most folks out there are anticipating. At the core of this mess is a truth we ignored too long. China holds about 60 to 70% of the global refined silver supply. When the main supplier curbs exports overnight, you do not get a slightly tight market. You get a massive supply shock. These shocks do not show up first in the headlines or charts. They manifest in fear, hesitation, and the brutal realization that paper contracts do not keep the factories running. Only physical metal does that. Hours after the ban hit, volatility spiked and confidence broke. The ticker showed one thing, but real damage was happening under the radar where physical silver stock was simply vanishing. This chapter lays the groundwork because once you grasp what has structurally shifted here, everything that follows becomes absolutely inevitable. If this matters to you, stick around. Hit subscribe so you don't miss the updates. Drop a 1 if you are stacking physical metal, or type 2 if you are watching this purely to trade the paper markets. To get why the reaction was violent, you must grasp what the ban means in reality, not headlines. At midnight, January 1st, 2026, China's Commerce Ministry implemented the new silver export licensing system. This was no warning shot. It was hard policy enforcement. Overnight, the global silver trade rules changed, and most of the market was totally unprepared for how restrictive this framework truly is. Just 44 companies are approved to export silver for 2026 and 2027. 44. Before this, hundreds of Chinese firms were active exporters, feeding refiners, industrial users, and bullion dealers in the West. The new rules wipe out small and mid-sized exporters. To qualify, a firm must prove annual production capacity of at least 80 tons, show a solid export record from 2022 to 2024, secure a $30 million credit line, and get direct state approval plus licensing. Miss one step, and you are out. This isn't a temporary bottleneck. It is structural exclusion. Firms that historically fed Western electronics makers, solar producers, auto suppliers, and bullion dealers are no longer legally cleared to export. They did not just slow down shipments, they stopped dead. When a country controlling the bulk of refined silver supply removes most exporters from the system overnight, the impact is immediate and brutal. Supply chains do not have redundancy built in for this type of shock. Contracts are written assuming continuity. Inventories are managed on just-in-time delivery models. There is simply no buffer for a sudden disappearance of supply from the world's dominant source. This is why the market reaction was not gradual, it was instant. Buyers realized within hours that this was not about price negotiation anymore. It was about access, and once access becomes uncertain, the price becomes secondary. The first 48 hours were not about speculation, they were about survival positioning. This is the true foundation of everything that follows, because once exporters vanish, the stress moves downstream, and that stress is already showing up in prices, premiums, and behavior across the entire market. The first place stress surfaced was price, but not in the way most people expected. In the days leading up to the ban, silver traded in a controlled range as markets tried to price in the risk. On December 30th and 31st, silver hovered around $75 to $78 per ounce. Volatility was elevated, but the structure looked familiar. Traders thought the impact would be gradual. They were dead wrong. When Asian markets opened January 1st, the reaction was immediate and violent. Silver surged to $84 an ounce within hours, printing a new all-time high. This was not algo momentum or slow repricing, it was panic buying. Large players rushed for exposure, simultaneously overwhelming liquidity. For a brief window, the market revealed what happens when fear collides with thin supply. Then came the pullback. Profit-taking accelerated technical selling kicked in, and headlines on geopolitical developments temporarily cooled safe haven demand. By the end of the session, silver had retraced toward the mid-70s. To an untrained eye, it looked like a rejection. In reality, it was a controlled retreat. The market had just absorbed a historic shock and did not collapse. By January 2nd, silver was swinging violently between $73 and $76, posting intraday moves of 3 to 5% within hours. This level of volatility is not normal. It signals stress. However, focusing only on spot price misses the real story. The screen price reflects paper contracts. It does not reflect availability. The real signal is what happens simultaneously in the physical market. While paper prices pulled back the cost to actually obtain silver, began to explode. This divergence is critical. When spot stalls but premiums rise, it means supply is breaking underneath the surface. That is exactly what the market is telling us right now. Price did not fail. It revealed the fault lines, and those fault lines lead directly into the physical market, where the huge disconnect between paper and reality has become impossible to ignore. If you want to understand what is really happening, stop looking at the spot price and start watching the premiums. Spot is the paper reference, and premiums are the truth. And since the ban went live, premiums across the physical silver market have exploded in a way that leaves no room for denial. In Shanghai, physical silver was trading roughly $8 to $10 per ounce above the COMEX spot price before the ban. That was already elevated. Within 48 hours of the restriction taking effect, reports showed premiums jumping to $12 to $15 above spot, with some desperate buyers paying even more. When silver shows $75 on a screen but costs close to $90 to actually acquire in the world's largest metals hub, the message is unmistakable. Physical supply is finally breaking. The same pattern is spreading globally. In the United States, American Silver Eagle coins that normally carry a $3 to $5 premium are now listing at $8 to $12 over spot at major dealers. Generic rounds that once sold $2 or $3 over spot are now $6 to $8 higher if they are available at all. 100-ounce bars, when found, are commanding premiums of 10 to 15% above spot. Many dealers aren't even quoting prices, they are quoting delivery times. Europe is no different. Dealers in the UK and across the EU are reporting doubled or tripled premiums widespread out of stock notices and delivery timelines stretching from days into weeks. India, already a major silver consumer due to industrial demand and cultural use, is bidding aggressively as Chinese exports dry up, pushing premiums to absolute record levels. This is what a real shortage looks like. Paper markets can pretend supply exists. Physical markets cannot. Premiums rise because metal is scarce, not because of sentiment. When buyers are willing to pay far above spot just to secure delivery, the paper price becomes totally irrelevant. And while retail investors are just beginning to feel this pressure, something far more serious is unfolding behind closed doors among industrial users. That is where the real panic has largely begun. While retail investors are noticing higher premiums and empty shelves, the real crisis is unfolding quietly inside boardrooms and procurement offices. Industrial users do not have the luxury of waiting for prices to stabilize. Silver is not an investment for them. It is a required input. And since the ban took effect, many of these companies have been pushed into emergency mode. Electronics manufacturers were among the first to feel the impact. One major producer in Southeast Asia reported being notified that first quarter 2026 silver deliveries would be delayed by 4 to 6 weeks at minimum. In a just-in-time production environment, that is catastrophic. Assembly lines do not pause gracefully. They shut down. A delay of this magnitude does not squeeze margins. It threatens output. Solar makers are hitting a brick wall now. Photovoltaic cells need silver paste, but Chinese refiners just told European buyers no new Q1 contracts. Old deals might hold, but future stock is a gamble. Some sellers won't even give a quote since they can't promise they'll get the metal. That isn't just a squeeze, It's a complete supply breakdown never seen before. Medtech firms are seeing the exact same shortages. Silver is vital for sterile coatings and gear. Vendors are declaring force majeure, refusing to lock in prices or dates. For the EV space, the squeeze is getting brutal fast. Every electric car demands heavy ounces for electronics and management systems. As EV assembly lines ramp up globally, the hunger for physical metal is absolutely totally unrelenting. Word is that EV parts makers in the West are grabbing physical at $85 to $90 an ounce just to ensure delivery. We aren't talking retail speculation here. This is industry paying any premium necessary to stop lines from halting. When commercial users stop caring about the rigged spot price, you know the market has smashed right past a critical breaking point. That is exactly why a single comment dropped back in late December carries way more heavy gravity now than it did back then. On December 27, 2025, right before the export freeze, Elon Musk replied to the news with a brief heavy warning. "This is not good. Silver is needed in many industrial processes." Back then, people shrugged it off as hype or noise. 48 hours into the lockdown, that tweet looks like the understatement of the century. Musk's empire depends on the shiny stuff. Tesla needs it in every single car from contacts to power systems. SpaceX burns through silver for high-tech aerospace and comms gear. When a guy with that much industrial exposure gets worried, you better listen up. And he isn't solo. Chiefs and buyers across every sector are hitting the exact same wall simultaneously. Security of supply is totally gone. Here is where the price action gets telling. Big banks and funds who usually love paper liquidity are quietly swapping derivatives for allocated physical bars. Those ETFs, once seen as easy proxies, are now viewed as liability risks. When the big boys demand delivery rather than rolling over contracts, it screams they have lost faith in the paper casino's ability to hold up under real pressure. Meanwhile, banks and industry giants are building private stacks not for gains but for sheer survival. This is strategic hoarding. It happens when players think the metal might vanish at any price tag. This panic buying worsens the squeeze because every physical ounce yanked from circulation tightens the noose on the system even more. We are watching the death of rigged price discovery. For ages, the futures casino set the price and physical followed. Now that dynamic is flipping. The physical street price is taking the lead and paper spot is lagging hard. Once the cost to get metal in hand becomes the real benchmark, the traditional exchanges lose all control. That loss of power gets incredibly dangerous when you look at the exchange sitting right at the heart of the paper scam. The pressure point in this crisis is the COMEX, where silver futures underpin global paper pricing. On the surface, trading continues as normal. Contracts swap hands, liquidity appears intact, and settlement rules stand. But beneath that surface, the structure is under severe strain. As of January 1, 2026, registered silver inventory on the COMEX sits at roughly 127 million ounces. This is the metal truly available for delivery. Against that open interest signifies over 1.1 billion ounces of paper. In simple terms, for every ounce of deliverable metal, there are nearly 9 paper claims. That leverage ratio only survives if participants never ask for physical delivery. That assumption is now failing. In early December, nearly 48 million ounces were stood for delivery in mere days, draining over a third of registered inventory. That was before China's ban even took effect. Now, the incentive to take delivery is far stronger. Physical premiums are rising and arbitrage trades are widening. When paper silver trades near $75, but physical metal sells far higher, elsewhere pressure on the exchange becomes relentless. This is how paper systems break through arithmetic, not emotion. London is flashing the same red lights. Vault stocks have crashed and lease rates have spiked, showing it is super hard to find metal for immediate delivery. High lease rates aren't just background noise. They are a siren. The paper market depends on confidence. Once that faith erodes, stability disappears really fast. As the paper scam cracks, another bottleneck is choking the whole system. Refining. Switzerland is key to the global stack, pumping out most of the high-purity bars industry needs. Refineries there turn door bars into the $9.99 stuff for tech and energy sectors. When refining lags supply, doesn't just get tight, it totally freezes up. Late December saw Swiss refiners tighten up export checks big time. Compliance jumped, paperwork grew, and approvals dragged. After China's ban hit, delays got worse. Refiners are now serving long-term contracts and big fish first, while spot buyers are looking at huge weights or getting flat-out rejected. This creates a massive fake-out. Rough silver might exist, but if it can't be refined to spec, it is basically useless. Manufacturers don't need silver someday. They need specific purity right now. Any hiccup in refining turns a tight market into a full-blown production nightmare. Simultaneously, this squeeze is speeding up a massive geopolitical pivot. China locking down silver isn't a random event. It matches a resource-dominant strategy seen for 10 years now. Rare earths, antimony, tungsten, they've all been restricted. Silver is just the newest piece on the board. The U.S. responded by tagging silver a critical mineral in late 2025. That admits the strategic value, but it doesn't magically produce ounces. Domestic mines cover a tiny fraction of what we burn, and new holes take years to dig. There is no quick patch for this. As countries scramble for scarce rock, this morphs from a market glitch to a strategic war, and silver is the king on that chessboard. To get why this mess won't fix itself fast, check the basic supply-demand math. Global appetite in 2025 hit about 1.24 billion ounces. Total supply mining plus scrap was only 1.1 billion. That is a structural hole of over 200 million ounces in just 1 year. That wasn't a fluke. It was the 5th straight deficit year. From 2021 to 2025, those shortfalls ate up nearly a whole year's global output. That missing silver came from above-ground vaults and strategic stacks built over decades. Those stockpiles are now running on fumes. Industry is the whale here. Solar alone guzzles hundreds of millions of ounces a year. Tech EVs, med tech, they all keep growing no matter the spot price. Silver isn't a choice in these builds. It is mandatory. The issue is that mining can't react to price spikes. About 75% of silver comes as a byproduct of digging for base metals. Output depends on copper or zinc demand, not silver prices. Even if silver doubles supply, stays flat. Primary silver mines are rare, and new ones take a decade to start. Scrap won't save us either. Most industrial silver is baked into stuff where recovery costs too much. Solar panels and tiny circuits are hard to recycle at scale. The verdict is solid. There is no fast way out. China's ban didn't cause this deficit. It just ripped the curtain off, and once a structural shortage is out in the open markets, don't go back to sleep. 2 days into the export ban, one thing is crystal clear. This isn't a risk model anymore. It is a live reset. The silver market is slamming into the reality it ignored for years, where paper IOUs crash into physical limits. That wreck is already happening. For decades, pricing relied on leverage and the bet that nobody would want the real thing. That faith is dead. Industry doesn't care about price. They care about possession. Big money wants bars, not exposure. When metal gets scarce, price stops being a ceiling and starts being a rocket fuel. The big question is not whether the shiny hits 100 fiat dollars. It is how the paper market gets there. An orderly path means sustained spot volatility, rising premiums, and gradual acceptance of real prices. A disorderly path involves delivery stress, forced cash settlements, and broken trust. Markets under this strain rarely move quietly. The lesson for us is strategic. Markets don't fail because spot rises. They fail when faith in the system dies. Faith in the vaults, faith in physical delivery, faith in paper settlement. Once that trust erodes, smart money moves defensively and fast. Ignore the short-term tamps. Volatility is noise. Stacking is signal. Physical is scarce, demand is hard, and time is not on the banker's side. Knowing what weight you hold and why you hold it matters more right now than ever. If this analysis helped clarify the squeeze, subscribe so you stay ahead of the next big move. Share this with anyone who needs the truth and leave your thoughts in the comments. This stacking story is far from over.